How to use this type of brokerage account for tax strategy, tax lots, capital gains, and early retirement planning or financial freedom earlier. Most people overlook the importance of what's called a non-qualified brokerage account and focus much more on 401k, IRA, Roth IRA, and more. You need to open this type of brokerage account and start investing. Very few know how to actually use it to reduce taxes, grow smarter, and retire earlier. In this video, we'll break down how to use this type of brokerage account as a strategic tax tool, covering what a non-qualified brokerage account is, how tax lots and cost basis works, short-term versus long-term capital gains tax and examples of visuals, tax loss harvesting investing strategies, and why these tax moves matter for early retirement and greater wealth. I'll walk you through how to use a non-qualified brokerage account as a tax planning powerhouse with visuals as well throughout, covering tax lots, capital gains, cost basis, wash sales, and so much more. Now, my name is David Lundberg. I'm a financial planner and tax strategist for almost 10 years now. I do hold 2 master's degrees and also a Marine Corps combat veteran and owner of Awaken Financial Designs. I do kindly ask you that if you do enjoy this video, you enjoy what I'm showing you here today, to kindly like, subscribe, or comment for more. That's greatly appreciated. Now let's go ahead and move on here to the very first section that we're going to be talking about here today, which is what is a non-qualified brokerage account, or NQ. Now, a non-qualified brokerage account is the language that professionals like me utilize, but most people call this account a brokerage account. Now, it's a taxable investment account that's a non-retirement account. That means there's no tax treatments that are favored, like a 401k, an IRA, or Roth IRA. However, here's the beauty. You can have more flexibility, more control that allows you to also retire earlier. You can contribute to any amount, withdraw at any time, and access an immense variety of assets or securities that you can invest in. Now, it could be a single account, a joint account with a spouse, it could be even a trust brokerage account, and so much more. But with that freedom comes various tax impacts, and that's where strategy begins. As I go over the upcoming information, it's important to know that at most brokerage firms, they will have what's called an unrealized gain loss tab or section that you can log into your account and you can utilize that. Again, that's the unrealized gain loss tab. So much of what we're going to look at here today, we'll be going over this. That way, if you want to pull up your own unrealized gain loss, you can utilize this to best go over that. So moving on here now, understanding the tax lot and cost basis. So every time you buy a stock, an ETF, or mutual fund, or something similar, you're going to have what's called on there a tax lot it creates. Now, it's going to have its own cost basis, which is what you paid for originally. Now, when you go to hit the sell button or sell that particular item on there, you should be able to choose the lot you want to sell. Now, most firms on there might default to what's called FIFO, F-I-F-O, which is first in, first out, meaning the first lot you bought will be the first one you sell when you sell. There is an option as well for what's called LIFO, L-I-F-O, last in, first out, meaning the last security or last time you bought something will be the first time it sells on there. Or the one that's most powerful is what's called specific share identification, where you can choose your own lot. Now, this allows you to choose which shares to sell, depending on whether you want to harvest a gain or loss, or minimize taxes in the particular year, or have a short-term or long-term tax impact that we'll be going over as well. Now, at most brokerage firms, when you go to the sell button, or you click on the sell screen, you should see an option like tax lot or select the lots. This way you can choose which ones you want to sell. Now, if you're not sure about this, you can always ask your brokerage firm how you can do this, or you can always just even go on Google or the brokerage firm on, hey, how can I choose my tax lots? Now, we're now going to move on to the next section, which is short-term versus long-term capital gains. Gains on investments held less than a year are short-term gains, and they're taxed like regular income. Now, if you hold it for more than 1 year, your gain qualifies as long-term capital gains, which gets a much lower tax rate, typically 0, 15, or 20%. There are 3 brackets. Now, in a prior video I made here on YouTube, I went over the long-term capital gains and gave examples as well, in case you want to watch that. Now, to help visualize, let's look at this chart here I have as well. to look at short-term versus long-term capital gains rates, and let's actually go over this here together. Now, you can see on here in the top left in green, capital gains tax rates for 2025, and you can see also in green in the column, there's a 0% bracket, a 15% bracket, and a 20% bracket. Now, we can also see on the right over here, we have the 2025 tax brackets for ordinary income. This is your short-term capital gains tax. Now, again, the tax rates you can see go from 10 to 12 to 22 up to 37%. Now, I've highlighted in blue here on each chart. Chart on the left, long-term capital gains. That 0% rate, let's say if you're married filing jointly, goes up to about $96,000. Now, if we compare that to a short-term capital gains rate, you can also see married filing jointly up to about $96,000, but that's taxed at 12% as opposed to 0. So we really want to optimize our overall tax planning strategy, knowing the long-term capital gains and the short-term capital gains tax. That way we can maximize what's out there as well for us to utilize. Now that we have covered that, this could save you tens of thousands of dollars in your overall investment strategy just by knowing these charts and choosing the lots you can have as well when you sell these. Now let's go on to our next section here, tax loss harvesting. Here's a favorite tool on what is tax loss harvesting. Well, if your investments are down or at a negative loss, meaning you lost money, you can sell them to capture that loss and use that to offset your gains. And you can even deduct up to $3,000 a year from your regular income too. You are also allowed to carry forward losses to future years. But let's look at a visual example here and actually go over this to break it down even more. Now, in this example, we are using a 35% tax bracket. So you could, as an example, use your own tax bracket and your own amounts to it. It is important to remember as well that this is first short-term gains and losses are paired, then long-term gains and losses are paired. So if you say have a long-term gain of $2,000 and a short-term loss of $2,000, then they offset to 0 and vice versa. Now let's look at the chart here to see a real example of what's going on. Now in this chart, on the left, we have investment A in blue. On the right, investment B in about that red magenta color. Now, we can see on here what's happening is there's a $25,000 capital loss on investment B. On investment A, there's a $20,000 gain that is owned. Now, we can use that loss of $25,000 to offset that gain of $20,000. So now the gain of $20,000 goes down to 0, and that $25,000 loss now has a $5,000 loss remaining. Now, remember, you can apply $3,000 as a loss in that current year on there. So we have $5,000 left. We take $3,000. That loss is now also reduced from your ordinary income on there. We have a $2,000 loss left. So that $2,000 loss left, we can carry forward to the following year on there. So again, this is very powerful to understand when the year is about to be over, tax loss harvesting, and how it can save you thousands of dollars depending on your own situation. Now, with that and warning and caution on there, it is important to be aware of what's called a wash sale rule. Now, you're not allowed to buy back the same or similar identical investment or security within 30 days, or the loss is disallowed and cannot be utilized. Now, that loss is not gone, but it is the loss realized in a wash sale. It's just reapplied to the future sale on there. That loss can now be applied to the cost basis of the most recent share. Not only does this add to the future increase in the cost basis of the purchase, but it will reduce the size in the future. So that wash sale rule, be very careful. If you want to realize that loss in the current year, watch out for that wash sale rule. Now, how can this help you retire earlier? Well, this is a non-qualified brokerage account, will certainly help you retire in early years because these tools give you something deeper than just tax saving. It gives you freedom. Unlike retirement accounts like an IRA, a Roth IRA, or 401k, there's a 10% early withdrawal penalty prior to age 59 and a half, plus an IRA or 401k would have additional ordinary income tax. Now the Roth IRA, the contributions only can be taken out prior to that age. However, any kind of growth or anything else might occur would also have penalties as well prior to age 59 and a half. As such, this non-qualified brokerage account, you can be accessed at any age without additional penalties or restrictions. You just have that short-term or long-term capital gains tax. You can even have, remember on that chart, a 0% tax using long-term capital gains up to a certain amount. Now, all of this adds up to one huge thing: retiring earlier and greater financial freedom with more peace and less stress. Now, financial independence and spiritual abundance. True wealth isn't just about growing your money, it's about protecting it. Using the tax code wisely is a form of protection tax strategy, and tax planning with account types, assets, and investments is crucial to greater net wealth, net gains, and an earlier retirement. So, whether you're on the path to retire in 10 years or in 2 years, this strategy is a sacred piece of your overall plan. This is just one strategy of many that, with other tactics our own firm uses to create and help you achieve greater financial freedom and retiring earlier. Now, we are at awakenfinancialdesigns.com, and please kindly do me a favor again. If you've enjoyed this video, please like it, subscribe to it, and comment below. I greatly appreciate it on here so I can have more mindful money and tax wisdom. And as always, financial independence and spiritual abundance, it starts with using what you already have wisely. Thank you so much. Sending you abundance of love, light, and life.